G'day. I thought I'd go through an example of a great Australian company that I use within our interview rooms on a regular basis. And the reason why we utilise this company as a prime example of a great business is because they've done it over many years. They've got great earnings growth, and it just shows that when businesses reinvest back into themselves, what they can achieve over that time. Now, I have picked out obviously a great example. There are many hundreds of terrible businesses that have just not on the market anymore. They've just gone into administration and turned into nothing, and that's where people can lose money. But that's generally where people are drilling into the ground hoping to find some sort of precious commodity of some type. But the company I'm keen to talk about was listed in 1994, and it's the Commonwealth Serum Laboratories. So we know it now as CSL. Now, I love to show this example. It is probably one of the best examples I can find in terms of share price growth and a business that's gone particularly well, but it's very interesting nonetheless. So back in '94, it was floated. The government sold it off to into a pub, so it's a public company at $2.40 per share. Now, it was early last decade. It might have been 01, 02. I can't really remember exactly where it was, but the share price went up, although I'm drawing down. It went from $2.40 to $90 per share. So extraordinary growth in that time. What happened then is the board, the directors decided what they'd do is they would split each one share into 3 shares worth approximately $30. So it was a 3-for-1 split. So for every 1 share you had which was worth $90, is now 3 shares worth $30. So what's happened since that time? We've seen further growth in the market. The healthcare sector, as you know, is probably an area that I do like, and the share price now is around 101. So in reality, when you look back at the history, and I know there's some great examples on Coca-Cola dating back to the start of last century, I think 1907, doing similar things in terms of splits, and the way it's grown is unbelievable. But so $2.40 is essentially now gone to $303 per share. Now, you ask me, how does that possibly happen? The growth is exponential, and surely it can't keep happening. Well, in recent times they have continued to do that. CSL, unfortunately, is always expensive when you look at the metrics, the PE ratios and the like. But the key driver, like any business or any asset, the key driver to its valuation is what income it provides. Now, interestingly enough, if we just go back to 10 years in 06, it made 21 cents per share. So good result. And if we go back to 94, that would be, seem very high. But if we wind the clock forward to 2015, it made, $3.79 per share. Now, of that share, they only paid out in dividends, I think it was, let's just say it was $1.60. Could have been a bit more than that, but they only paid out a fraction of actually what they made, and what they do is they reinvest it back in their business. So that concept of retained earnings and what the payout ratio is, CSL has always had a low dividend. This works out around 1.5%. But they retain so much of their money to reinvest back in the business, which again increases the income. So hopefully this income will go up over time, and that's why we invest into businesses, because if the income goes up over time, it will change the valuations from that to that to that. So that's why we're in this space, and why I keep talking about this area of earnings growth, and a key metric to value any asset. Thanks for listening.